Have you ever wondered how the stock market really works? Why do some people build wealth while others fall behind? What if the secrets to smart investing were easier than you think? In this video, we dive deep into Learn to Earn by Peter Lynch, a powerful guide for anyone curious about business, money, and the market. Whether you're a complete beginner or just want to sharpen your skills, this video will walk you through every chapter, from the basics of capitalism to real investing strategies. So sit back, stay sharp, and let's explore how the world of money really works. Everyone knows what a doctor or lawyer does. But what about a stockbroker? In this chapter, Peter Lynch explains how he became one. He started out just like any regular kid, mowing lawns, caddying at a golf club. But those experiences taught him something big. Money moves. At the golf course, he listened to business people talk about stocks. One name kept coming up: Flying Tiger Airlines. So, as a teenager, Peter bought shares in it. That investment grew, and so did his interest in the stock market. He didn't come from a wealthy background, no special connections, no secret path. He just paid attention, asked questions, and stayed curious. By college, he already had a strong grip on investing. Later, he joined Fidelity and turned a small fund into one of the best performing in the country. The lesson? You don't have to be rich to start investing. You don't need an MBA to understand business. What you need is curiosity, observation, and patience. Stockbrokers aren't born. They're made through experience, learning, and smart decisions. To understand the stock market, we first need to understand capitalism. Capitalism is a system where people own businesses, not the government. It's built on competition, risk, and reward. The goal? Make a profit by creating something others want or need. This chapter takes us back to early trade, when people exchanged goods like food for tools. But as societies grew, money replaced bartering. Businesses formed, and people started investing in them. Capitalism took off during the Industrial Revolution. Machines changed everything: how we worked, lived, and made money. Companies like railroads and steel mills needed huge funding, so they sold shares to the public. This is where the stock market began, people pooling money to fund big ideas. And in return, they earned a share of the profits. But capitalism isn't perfect. It goes through ups and downs, booms and crashes. Still, it remains the most powerful system for creating wealth and innovation. The key takeaway? Capitalism rewards smart ideas, risk-taking, and hard work. And the stock market is where all of that action happens. Investing sounds complex, but it all starts with a simple idea. Put your money to work so it can grow over time. In this chapter, Peter Lynch explains what investing really means. It's not gambling or guessing. It's owning a piece of a business that makes money. There are different ways to invest. You can buy stocks, bonds, real estate, or mutual funds. Each comes with its own level of risk and potential reward. Stocks give you a share in a company. If the company does well, your investment grows. If it struggles, your investment may shrink. Bonds are loans to companies or the government. They tend to be safer, but they usually earn less. They can be a good way to balance out risk. Real estate can be another option. People invest in property to earn rent or profit when prices rise. But real estate often takes more money and effort up front. Mutual funds pool money from many people to invest in a mix of assets. They're managed by professionals and are great for beginners. They offer diversification, which helps lower risk. The earlier you start investing, the more your money can grow. That's because of something called compound interest. It means your money earns money, and then that money earns even more. Over time, this can make a big difference. Peter Lynch also talks about the value of long-term thinking. Don't chase the latest trend or panic when markets drop. Stay focused on your goals and be patient. The market will have ups and downs, but history shows it grows over time. The most important lesson? Invest in what you understand. If you know a company, its products, and how it makes money, you'll feel more confident in your investment. And confidence helps you stay calm when things get rough. In the end, investing isn't about luck. It's about knowledge, patience, and making smart choices. Start early, stay informed, and let time do the rest. The stock market isn't just one place. It's a system that connects buyers and sellers from all over the world. Think of it like a giant marketplace. Instead of fruits or clothes, people trade shares of companies. When a company wants to grow, it can go public. That means it sells shares of itself on the stock market. Anyone can buy them and become part owner of that business. The price of each share is decided by supply and demand. If many people want to buy, the price goes up. If more people want to sell, the price goes down. Markets open and close every weekday. And during those hours, billions of dollars can change hands. But it's not random. Behind every trade are reasons: earnings reports, new products, world news. Some people try to make quick profits, buying and selling in days or even minutes. Others invest for the long term, holding stocks for years. The stock market reflects the economy's health, people's hopes, and sometimes fears. It rises and falls, but over time, it's grown and rewarded those who stayed patient. It's not about luck. It's about understanding the system, staying informed, and thinking ahead. Because the stock market isn't a game, it's a tool. And when used wisely, it can build wealth for life. Want to know the most powerful force in investing? It's not luck or timing or insider tips. It's time. In this chapter, Peter Lynch shows how starting early can turn small amounts of money into serious wealth. Let's say you invest $1,000 at age 20 and it grows 10% each year. By age 60, that $1,000 becomes over $45,000. Why compound interest? That's when your money earns interest, and that interest earns more interest, year after year. The longer your money stays invested, the more powerful the effect becomes. Waiting just 10 years to start can cost you thousands in the long run. Peter reminds us, you don't need a lot of money to start. You just need time, consistency, and patience. And time also helps with market ups and downs. Prices rise, fall, and rise again. But if you stay invested long enough, history shows the market grows. So don't worry about trying to time the perfect moment. Start now. Let time do the heavy lifting. In investing, time isn't just a friend, it's your biggest advantage. There are some simple truths about money that many people never learn. In this chapter, Peter Lynch lays them out clearly. First, you will spend your life working for money, but you should also learn how to make money work for you. That's where investing comes in. Second, money loses value over time because of inflation. That's why saving it in a jar or under a mattress won't help. You need to grow it, not just store it. Third, starting early makes a huge difference. Even small investments can grow big with time, thanks to compound interest. The earlier you begin, the more time your money has to multiply. Fourth, not all debt is bad, but you must control it. Credit cards, loans, and overspending can ruin financial health. Understanding the difference between good debt and bad debt is crucial. Fifth, no one cares more about your money than you do. You have to take charge, learn the basics, and make smart decisions. Peter reminds us, you don't need to be a math genius or a stock expert. You just need common sense, discipline, and the courage to start. The facts of life aren't just about biology. They're about money, time, and choices. Learn them early. Live by them always. And you'll have a future full of options, not limits. A stock is more than just a symbol on a screen. It's ownership, a piece of a company. When you buy a stock, you become a shareholder. That means you own a small part of that business. Let's say you buy stock in a shoe company. If the company sells more shoes and makes more money, its value goes up, and so does your stock. But if business slows down, your stock could lose value. Stocks are bought and sold on stock markets, like the New York Stock Exchange. Prices change all the time, based on how people think the company will do. Sometimes people get excited and drive prices up. Other times, they panic and sell, driving prices down. That's why the market can feel like a roller coaster. But smart investors don't just follow the crowd. They do their homework. They learn about the company, its products, and its future. There are two main ways to make money from stocks. One is through capital gains, buy low, sell high. The other is dividends, when companies share profits with their shareholders. Stocks come with risk. But with risk comes the chance for reward, especially over time. Owning stock means believing in a business, and investing is about choosing businesses that grow with the world. You might not realize it, but stocks are a part of your life. Every time you buy a phone, eat at a restaurant, or wear your favorite shoes, you're supporting companies. And many of those companies are publicly traded on the stock market. When you invest in stocks, you're not just hoping to make money. You're becoming part of something real, a business that makes products, pays employees, and grows communities. Peter Lynch reminds us, the stock market isn't just for rich people or experts. It's for anyone who wants to build a better financial future. Owning stocks means your money works for you, even while you sleep. As companies grow, so does your investment. And it's not just about wealth. It's about understanding the world, knowing how businesses operate, what drives success, and where the future is heading. You don't need to invest in every company, just the ones you believe in, the ones you understand. Stocks give you a voice in the business world, a chance to be more than a consumer, to be an owner. So what do stocks mean to you? They mean opportunity. They mean growth. They mean you have a stake in the world around you. School teaches us math, history, and science. But often, it leaves out one major life skill: how money works. In this chapter, Peter Lynch points out the gap between school lessons and real-world business. We learn about ancient battles and famous explorers, but not how a company makes a profit or what a cash register really means. Every store you walk into, every product you buy, behind it is a business trying to earn more than it spends. Understanding that simple truth is key to understanding investing. Peter explains how businesses succeed. They sell something people want, manage costs, and keep growing. Even a lemonade stand follows this logic. Buy lemons and sugar for less than you sell the drink. The difference? That's profit. But most schools don't show students how to read a company's financials or how to invest wisely for the future. That's why learning about business and investing is something we must do ourselves. The world runs on money and decisions. The better we understand both, the smarter our choices become. School may ring the bell, but the cash register is where real lessons begin. Not all leaders are created equal. In this chapter, Peter Lynch shines a light on bad CEOs, the ones who care more about their image than the company's success. Thus, these chief executive offenders focus on short-term stock prices, lavish perks, and flashy deals, often at the cost of long-term growth. A good CEO builds value, treats employees with respect, and invests in the company's future. A bad one? They cut corners, chase headlines, or make risky moves to boost profits temporarily. Peter warns investors to look beyond the press releases. Study how leaders behave, not just what they say. Check how they spend company money. Watch how they handle tough times, because leadership matters. A strong company with weak leadership can fail, but a good leader can turn an average business into something great. As an investor, knowing who's running the show is just as important as knowing what the company sells. Markets may seem chaotic, but behind the scenes, they're guided by something powerful: the invisible hand, a concept introduced by economist Adam Smith. This hand represents the natural flow of supply and demand. When people want more of something, its price rises. When demand drops, prices fall. No one controls it directly, yet it shapes everything, from the price of bread to the value of stocks. Peter Lynch explains how this invisible force makes capitalism work. It rewards businesses that meet real needs and punishes those that don't. It also means businesses must keep improving, because customers have choices and competitors are always catching up. Understanding the invisible hand helps investors see why some companies win while others fade away. The economy isn't controlled by one person. It's a system built on millions of decisions made every day. That's the power of the market. And it all happens through the invisible hand. In the world of investing, one word matters more than most: earnings. Earnings are the profits a company makes. They show how well the business is performing. Peter Lynch says if you only remember one thing about a company, make it the earnings. Companies that grow their earnings year after year usually see their stock prices rise. Why? Because profits attract investors. You can find earnings in quarterly and annual reports. Look for trends. Are profits growing? Are costs under control? Be careful of companies that play accounting tricks to hide bad news. Real earnings growth is steady and backed by real business performance. Also, understand the difference between earnings and revenue. Revenue is what a company brings in. Earnings are what's left after all expenses are paid. Focus on companies that turn revenue into strong, growing earnings. Because at the end of the day, it's not the hype or headlines that build value. It's earnings, earnings, earnings. Peter Lynch ends with a challenge. If you've made it this far, you've already passed the first test, caring enough to learn. This chapter isn't about memorizing facts. It's about using what you've learned to think clearly about money, business, and investing. Know how capitalism works. Understand the stock market system. Recognize what makes a company strong. Remember the lessons. Start early, stay curious, and think long-term. You don't need to be rich to invest. You just need to start, stay consistent, and avoid panic. The stock market isn't a casino. It's a tool for turning your knowledge into future wealth. So here's your real final exam. Will you apply these ideas to your life? Because the smartest investors aren't always the ones with the highest IQ. They're the ones who take action. I've just finished the full breakdown of Learn to Earn by Peter Lynch. Now you understand more about investing than most people ever will. But knowledge only works when you use it. So take what you've learned, think long-term, and start your journey with confidence. If you found value in this video, support the channel. Like, subscribe, and hit the bell so you don't miss what's next. This is Savage Trading, where smart investing begins.